NASDAQ also weaker. The major indices suffering losses yesterday again. The NASDAQ flirting with bear market territory. It is down just under 20% from the highs. We've got tensions over the possible government shutdown, as well as Wednesday's Federal Reserve meeting and the interest rate hike dragging down markets. Joining us right now is BNY Mellon Investment Management Chief Strategist Alicia Levine. Alicia, great to see you. Thanks so much for being here.
Thanks for having me.
Well, we know the worries. What do you do about it? What are you telling clients right now?
So we're telling clients that we think that there's a little bit more left to the sell-off because we see structural levels sort of holding in the 2,400 area for the S&P, but that it's a little too late to sell. Right. So you just at this point, you should hold on. You should expect some support in that area, and then there'll be a buying opportunity.
What about the global growth slowdown? Is that going to, impact earnings? And do you really want to buy with the earnings expectations where they are if they're going to come down?
So in a typical year, earnings expectations come down about 3% from January through whatever we wind up with the end of the year. I think we're going to get another year like that. So the market is very suspicious about the 8% earnings growth for next year. You have to wait for those earnings growth expectations to come in. We're really looking at a 4 to 5% for next year. When that happens, I think then you've got the information into the market, and then you can start buying.
Lindsay,
what do you think about the tech sector in particular? You have the NASDAQ nearing bear market territory. Some of the stocks within the information technology sector within the S&P 500 are down 30, 40 or more %. Can you get involved now? Are there some sub-industries that you're interested in?
So I think it's too early to get involved in the large cap tech sector. When you have a sector like that, which ran the market up and was traded parabolically, right? These stocks were up 100%, 150% on a 12 to 18-month basis. They're not investable right now. They have to come back down to a more regular level. They have to normalize, and it hasn't happened yet. And they led the market up, and they're leading the market down. It's not done yet. It just isn't.
Treasury Secretary Steven Mnuchin weighed in on the reaction to the Fed's recent rate hike. He was on Fox Business yesterday. Watch this.
I think clearly you have a situation here where the market has overreacted to the Fed's comments, and you see program trading taking over. I think that the market was disappointed in the chairman's comments, but I would say if you look at the specifics, you can't just look at the headline, which was 2 more rate hikes. You have to look at actually the 17 dots on the dot plot.
Do you think the market overreacted?
So the market clearly was convinced that we were getting data dependence for next year and a more contingent Fed, and they were hoping for Jay Powell to express that. So whether it was realistic or not to expect it, that's what the market wanted to hear. And the market heard a concrete 2 hikes for next year. It didn't hear contingency. It didn't hear data dependence. And that's part of the reason the market sold off.
And I'd add to that, some people say, I'm not in this camp, but that you could see a recession next year. So if you have what would be the worst case scenario for the markets would be a recession or slowing growth, grinding to a halt, and a Fed that's already committed to raising rates. I think that's what has really been spooking the market. But I differ a little bit from what you said earlier in that I think it's a great opportunity to buy when things are down. When you have 20% drawdowns in the market, the last thing you want to do is sell. What you want to do is look for opportunity for people watching at home.
Agreed. I just don't think we're done yet. I think, first of all, the market hasn't hit support yet. We crashed right through 2450 yesterday, which was one of the first levels of support. So we're probably going lower, probably another 4%. But that's in the short term. I do think earnings have to come in realistically for next year. The earnings numbers will be very contingent on what happens with China and whether we actually smooth out trade relations with China or not. So even though trade with China and tariffs will not hit the overall economy, and to that extent the administration is correct, we're not really going to hit the economy that much. It's going to be filtered through individual companies. And in the end, markets trade on corporate earnings. So you're going to get a sort of telescoping effect on the earnings side, both positive and negative. So you really want to see trade smoothed out with China to be confident in the earnings.
And I don't think that it helps where you have, it's not just the Treasury Secretary, but other people in the administration, Trade Advisor Peter Navarro, even the president himself, constantly talking about the stock market. And Secretary Mnuchin saying, oh, investors, you overreacted to the Fed, and investors are sitting back going, no, we didn't. So I think he's trying to school investors on basically how to place bets. And I think that it will hit you in the face if you're not careful.
Is there an argument to be made that you do want to take some money out of stocks and put it in fixed income? If you're getting almost 3% on the short end, does it make sense to reallocate?
Look, part of the drawdown is the fact that there are alternatives. So there's safe alternatives in cash. Cash hasn't been an asset class in 10 years. Now it is, and this is the best performing asset class this year. So there's an alternative to equities, and the short end of the curve is a great place to put money right now, and it's safe. So that's
the 10-year looked great at 3.25 yield.
Yeah.
We said that on this program.
That's right. So what do you do now on the 10-year? You're trading, you've just come off 50 basis points. What do you do now? So there is an alternative. That's part of the reason for the rapidity and the intensity of the drawdown. There's someplace else to go.
Right.
I just think we're getting to a level of support in the market. You have tax loss selling this time of year. This is the time of year. If you're not getting a Santa Claus, if you're not getting a Santa Claus rally, you're having people taking losses, and they're taking losses over the next 10 days. You just have to live with it.